What's up, guys? We're going to be talking about head and shoulders today, the head and shoulders patterns, how to trade them, how to identify them, advantages, disadvantages, how not to trade them, examples. You guys know the deal. This has been the spread. This has been the dealio with the past couple of videos. So let's get right into it. This is kind of a longer, hold on, my chair is messing up here. Sorry about that. This is going to be a little bit longer of a video, head and shoulders. Just wanted to go very kind of more in depth with them because they are kind of more of an in-depth pattern. So anyway, head and shoulders patterns are reversal patterns, right? We in the previous video, if you watched our latest video, that was a continuation pattern, a flag or a pennant pattern. Today we're talking about a reversal. So that's where the price reaches a high and then reverses to the downside, or the price reaches a low and then reverses to the upside. So it's a reversal pattern, and it consists of a head, which is a high, and then two shoulders, which are two lower highs. So regular head and shoulders is bearish, and inverse head and shoulders is bullish. The origin's kind of hard to find, but it's been around since at least the 60s. Boom, let's go to the next part. Head and shoulder patterns, they are formed by one higher high, so that's the head right there, and then two lower highs, and then they form that head and shoulders patterns. Head, shoulders. So it forms that exact same pattern. Of course, it's not always perfect, like we can see. Let me get my laser up here. That we can see in these two graphics here, but it will always look, it might look a little shifted where the shoulders axis is like ascending like this or descending, but you got your head, your peak, and two shoulders. So it's very easy to visualize once you guys get the hang of it. That left shoulder is formed after that large extension up forms that left shoulder, the high. Price then pulls back, finds support at a level, pushes and bounces off of that level that finds demand there. Then the price pushes beyond that first shoulder to create the new peak. That would be a higher high. Price then recedes back down to the support, creating that double touch, that neckline right there. That'll be a very key important part come after the next shoulder here. Price pushes off of that neckline, creates the right shoulder, or the second shoulder, if you'd like to call it that. And then price eventually then comes back down to the neckline and breaks down. And that's when you take the trade. And that is a bearish head and shoulders. And then you have your bullish inverse head and shoulders, which is just the inverse of that. So what are head and shoulders patterns? Well, a couple tips about them. One, volume should be less on the right shoulder. So the volume overall on the right shoulder should be less than the peak and less than the left shoulder, excuse me. That is a really, really key component. A break of the neckline. So the break of the neckline is right here, right? Clear identified support on both levels. So this is your neckline. So a break of that neckline confirms a continuation of that downtrend if you're playing a regular head and shoulders, but it confirms that continuation of the price and then extends beyond down below that neckline. To get that measurement, we want to take the peak or the head, the top of that, measured down, excuse me, again, measured down to the neckline and then extend that measurement down beyond below that neckline, and that will be your total extension after the pattern has broken that neckline. So we'll go a little bit deeper into this. We'll be looking at some examples as well. If there's lower volume on the original break, it's much less reliable. And that's with every pattern, but we're talking about head and shoulders today, of course, but that's with every pattern. Whereas you want to see, generally speaking, you want to see more volume on your breakouts because that's going to signal a very strong breakout. If you don't have that volume there as you're breaking the neckline of any pattern, it signals that it could be a complete fake, or it's increasing the likelihood that it will be just a poor break in general. So you won't get that normal extension beyond, or it might even, again, be a fake break where it'll come right back down or right back into the pattern that you were just trading. A true break of the pattern is that neckline. So that's really, really important to note there as well. And there's always going to be that retest that's going to retest that neckline again, and then continue on down or continue on up, depending if you're playing on the regular or the inverse head and shoulders. And it's definitely important to keep that in mind because you can either trade the breakout and then unwind the trade at the end of that breakout and then rerun the trade after the retest rejects off the neckline, or you could add your position in. You could add, say, a 10, 20% position size on the break of the neckline, allow it to come down, retest, and then add a full position, add the other 80, 90% of your position there, whatever it is, whatever your risk tolerance is, add the rest of your position at that retest once it rejects, and then trade it the full extension down. And like I said, we'll look at a couple examples. So this is really important here, and I'm going to try and make this as least complex as possible. So most of the time the pattern isn't perfect, of course, right? So we see on this graphic right here, not perfect, left shoulder lower than the right shoulder. You've got an ascending neckline right there. So if that neckline is ascending, then the low of this right shoulder should, not has to, but it should be lower than this left shoulder here. And the only reason it should be is because that's going to allow you to know that the sellers have more control, essentially, in the easiest terms. So the sellers will have more control if that low of the right shoulder is below and basically inside the left shoulder. It's going to allow you to see, okay, the sellers have more control. They're bringing the price lower and lower. And even though that neckline is ascending, there is seller pressure that is continuing there. If it's not, it's going to decrease that probability of the setup. And it could become too skewed, and the play could actually, or the pattern could actually not play out the way that you are anticipating it to play out. If it's an inverse head and shoulders, and we'll look at a chart in a second, then ideally the low of that right shoulder is higher than the low of the left shoulder. So it's actually an ascending neckline on the other side as well. If it's descending, if the neckline is descending, then it's not like you can't trade it, however, but you don't have as much of a high probability of that breakout. You're going to need a lot more volume and a lot more buying pressure to break out of that neckline. It's not as more of a, for me personally, as a profitable trade as far as inverse head and shoulders and head and shoulders go. So again, to measure that extension, we would just take that head measurement, the depth of that peak down to the neckline, take that measurement and then extend it down, and you'll find that where that measurement should go to. So say it was 5% from the peak down to the neckline here, it should be another 5% down to the neck, down to where that full extension should be. Let's talk about some advantages or disadvantages. Well, one, it's great for seasoned traders. Like I said in the beginning, it's pretty easy to identify, right? Head and shoulders. I'm not going to finish that joke. It's great for seasoned traders because it's really easy to identify. It's easy to define your risk and take profit levels, and we'll get into that. And it's also identifiable on all time frames and can be traded in shorter time frames, like say 5 to 10 days or 10 to 20 days. Whereas, a lot of these patterns, you don't necessarily want to be trading them in too short a period of times. Like we like longer periods of times, at least 10 to 14 days, a couple weeks minimum for these patterns, like a cup and handle to play out. And that way you can actually have enough data that's going to show you an accurate resistance level neckline where you can break out of to the upside or break out of to the downside, right? So some disadvantages is that sometimes it's a little difficult to identify for newer traders, but an upside to this is that it comes pretty quickly. Again, head and shoulders is pretty easy to see. So it's very good. It can also just be a little bit more difficult to trade in general because it is more of an advanced pattern. Anyway, price can retest that neckline. A lot of the time it is going to retest that neckline, which can stop traders out or confuse newer traders and non-seasoned traders, which makes it a little bit more difficult for a newer trader. Risk to reward ratios can become skewed when the pattern isn't completely perfect. That's why I left that tidbit in there about the ascending necklines and what to look for an ascending neckline on a regular head and shoulders pattern and descending on a inverse head and shoulders pattern. And then lastly, the head and shoulders can be a fake and turn into a flag pattern or a nice W pattern. To mitigate that, just play the break of the neckline. Don't try and skip the jump, and try to play in between. Just trade the neckline and know that when you break the neckline, that's where your extension will truly begin. And that's where you'll be able to capitalize on the pattern for real. Anyway, how are we going to identify this pattern? Well, we have this saying here. I say it all the time: zoom out, actualize, zoom in, monetize, actionize, whatever floats your boat, however you want to say it, but zoom out and get the bigger picture of things. Are we in an uptrend? Are we in a downtrend? Is the price looking like it's, are the buyers control? Is it looking like it's rounding its top? Is there a head and shoulders in this bull trend? Okay, is there an inverse head and shoulders in this bear trend here? The only way we can do that is if we zoom out, go to that weekly chart, go to that daily chart, and then just gradually work our way in until we see, okay, these are going to be our identified necklines. This is our identified level of support, identified level of resistance. I've got my stop loss marks, my take profit marks, and we're going to do that by going through weekly, daily, 4-hour, hourly, 15-minute, 5-minute. People have different preferences, but the whole point here is to start wide and then go tight. So let's continue this. Here's a nice little graphic of NASDAQ NDAQ, just to be upfront about it, just so you guys know it's not NASDAQ futures or like the actual composite itself. It's just NDAQ, right? So that's why the price is $107, just in case anybody caught on to that right there. But this is a nice inverse head and shoulders setup right here that was at the time of taking, pretty nice setup. We actually failed this breakout line today on real NASDAQ futures and composite. We failed this breakout line today, and we're actually potentially rounding ourselves to the right side and to the downside now. But anyway, most head and shoulders patterns are identifiable and identified on the 4-hour or 1-hour time frame. Typically, they take about 1 to 4 weeks to develop. However, like I said before, you can find those that develop in 5 to 10 days, which is actually really nice. You can see this was over the course of 1, 2, 3, 6 days. This was the 6th day right here, and the 7th it failed. So it can happen in that shorter time period where it's 5 to 10 days. More often than not, head and shoulders patterns on a longer time frame contain smaller head and shoulders inside of each shoulder and head itself. So it's really, really kind of cool because you can, if you identify on that larger time view, right, you zoomed out and you're on your weekly chart or your daily chart and you're looking, you see this ginormous head and shoulders pattern about to play out. You might be able to zoom in and say, oh, wow, I see a short-term head and shoulders pattern on this right shoulder that's forming of this overall larger head and shoulders pattern. So you can get one step deeper and trade inside the patterns. If you recall, we actually looked at something similar when we were doing the W&M's pattern video. If you haven't checked it out, highly recommend you check it out. Just go through our channel, it'll be on there. But we looked at a chart of AMD. It was a gigantic M pattern, and inside of the M, there was a few different M's you could have traded, W's you could have traded. So it was really, really helpful for a lot of the viewers to see that, because that kind of opens up your eyes. Like if you see something on a larger time frame, you can zoom in and typically find the another smaller pattern, similar pattern on a smaller time frame to trade in a shorter period to capitalize on a daily or intraday time period, which is nice. So when trading the head and shoulders, it's important to keep it in mind that this is actually a reversal pattern, right? Until that pattern's complete. And the reason why I say until that pattern's complete is because trend could reverse thereafter that pattern is complete. So you could be playing an inverse head and shoulders in what is a shorter, or you could be playing a shorter term inverse head and shoulders in between a longer term downtrend, or vice versa. You could be playing a shorter term head and shoulders inside of a bull trend, a longer term bull trend. So that's why I put that in there, until the pattern is complete, right? So after that pattern is complete, you want to reassess the situation, look at that chart again, zoom back out and say, okay, where are we now? What's the sentiment now? Has it shifted? Has it not shifted? What's going on, right? Another tidbit, volume decreases on that right shoulder and increases on the breakout. That's the key right there. You want it to increase on the breakout. That pattern typically takes 5 to 10 days to develop for those smaller patterns, and 4 to 10 weeks for the larger patterns to develop. But it can form over a period of a few months. We'll actually look at an example of that here in a second. Stop losses, when you're using stop losses on the head and shoulders patterns, they're technically placed at the top of the right shoulder on a regular head and shoulders, or the bottom of the right shoulder on the inverse head and shoulders. So that's really, really important to note. However, that's more of a customizable and personal note to your own personal risk tolerance. So definitely keep that in mind, where, you know, if that's too much of a risk for your account, then don't just go by the textbook, go by your own rules that you've set out for yourself always. But it's important to know what the textbook tells us, right? Literally what the institutional textbook tells us. And then lastly, price action prior to the peak. That typically forms a flag. And like I said in the beginning, go back, watch our flag video and check that out, because you'll see what I'm saying here in a second. You'll be able to see that flag that forms in there, which is cool, because you can trade that as well. And then technically, again, that breakout is on the break of the neckline. And traders that are more seasoned will sometimes take a trade on the individual shoulders down to that neckline, in short to either play a W or an M pattern inside of there, or a mini head and shoulders. But that's for more seasoned traders, and we do recommend, everybody, try and test it out, maybe in a sim account, or at least plan it out and say, okay, on this right shoulder, I see this W, I see this mini head and shoulders in here. I'm going to, what if I took a trade right here, this neckline break, is it going to come down to my overall larger neckline? Test that out, back test it, and see if it actually works. And then you can actually implement it into your trading. That's how you get the experience and become a better trader. So here we're looking at actually hand drawn, because it was just the easiest way to do it. I couldn't make it, so I just figured I'd hand draw it. So you got to deal with my chicken scratch for a second here. But if you can see on this left photo here, we're going to focus on this left head and shoulders on the left photo. These traders, I was just talking about this, more seasoned traders might take a position on this right shoulder. Say this is a little M pattern in here, or maybe a smaller mini head and shoulders where they take a break of the neckline and trade down to the overall large neckline that is developing on this head and shoulders. That does happen a lot. A lot of traders will do that. Sometimes they'll carry out the whole trade down, they'll wait for it to retest, add in on the rejection, and then even carry it down. So they'll be early to the pie. However, a lot of traders, if you're a scalper or not a scalper, but a day trader, then you'll likely be able to pinpoint this trade and execute perfectly down to that neckline, reposition, and then trade on the neckline the next day, etc., or swing into the next day, however it fits your trading style. Now looking at this one right here, you can see that traders also execute their orders on the break of the neckline and trade that initial breakout or that initial breakdown of that neckline here, right? And then if you can see on the right side, this is generally speaking how that price action looks after the break of the neckline goes. So you have your left shoulder, your head, and your right shoulder. And then your break would be, the break of the neckline is this first break here down. It's going to bounce on a support, retest your neckline, rejection, and it'll reject and then pull back even further down and get that full extension in. And again, to get that measurement of the extension, you take the peak down to the neckline, and then you just extend that beyond, below that neckline or above that neckline, and that's your measured extension there. So going forward, let's take a look at this NASDAQ chart. Again, I put this on the 4 hour this time. I think last time it was on the 1 hour. So now you can kind of see it's a little bit clearer. You've got the left-hand shoulder, the left shoulder, the right shoulder, the head. Measure it out. It's about 8.22% from the neckline down to the bottom of the wick. Personally, I did this because this is going by textbook, but personally, I would have only measured to the body. I pay a lot of attention to the body and then make note of the wicks, because that's like your outbounds extensions, where there's trading ranges, if you want to call it. So personally, I would have only done it to the body, but going by the textbook here, 8.22%. If we take that and flip it above the neckline, we can see that 8.22% is about $14.22 above, putting us at $187. So that would be a trade that you could take if you were to break the neckline, retest, confirm a rejection off the neckline, or bounce rather, and then continue that play up towards that 187.22 to complete that. It's always really important, I just want to make note, always really, really important that you will always want to combine patterns, indicators with support resistance line and combine them together to get your confirmation. In here, we don't see anything. All we see is the pattern. So we stick a volume chart on here. We want to know what's going on with volume on that breakout, right? Maybe an RSI chart, you like that, or in MACD to help you confirm, okay, this breakout is happening right now, or, oh, actually, you know what, this might be a false breakout. I'm going to wait a little bit. There's no volume. The MACD hasn't crossed, and the RSI is not really showing much strength. So I'm going to hold off on this break right here. So anyway, continuing on, here's another example. This is a firm. This was super textbook. This was after a firm dropped. After it dropped on earnings, this was way back here. It kind of messed around, traded sideways for a little bit, and now it's fallen even deeper. You can see this left shoulder that's developed, the head down here, and then the right shoulder. Very simple inverse head and shoulders in a down market. There was a lot of inverse head and shoulders at the beginning of this week, end of last week. If we're talking about, today is the 3rd of March. So last week was the 22nd, I believe, the week of the 22nd. This is the week of the 28th. So between the past week-ish, there's been a lot of inverse head and shoulders. Some had failed, some have actually played out. Affirm was a great trade. We actually did trade this. I personally didn't capitalize on all of the movement, unfortunately. However, I did capitalize on some, which was very nice. because I accurately identified, okay, this is inverse head and shoulders. Here's my neckline. Here's my resistance. I'm going to trade up to here, and I executed pretty nicely. So anyway, if we take our measurement down from the neckline, we'll get 19.25%. And then we were going to take that and extend it above the neckline, right, to get that measurement extension of where that trade should go. If you went to the chart now, I believe it was just shy, and it actually stopped around this $45-ish price, 44, 45-ish dollar price, which is okay because we had already relinquished and unwound our trade at that point. However, it's very important to note that if that happens and you don't actually get your full extension, by textbook law, the measurement and the extension should be the same. Excuse me, the extension that you've measured should be the same. So if it's 19.25%, but say it only goes 17%, then you're in a weaker than average inverse head and shoulders. That makes sense, right? Because if it's predicted 19.25% and it should go there technically by technical law, and it doesn't, then your buyers are weaker. And if it goes above, say 22.25% or whatever, 3% extra, then your buyers are even stronger. So that trend might continue on further past that. It might form a flag, continue up, stair step up. We talked about that in the flag video. Again, check that out if you haven't already. Moving forward one more time, I know this is a meme stock, had to bring it up. I also wanted to show it in TOS because personally, I don't trade on TradingView. And these candles, sometimes when I look at the chart, I'm like, I don't even know what I'm really looking at right now. I don't really like TradingView too much, but it has great drawing capabilities. So I figured I'd show it in TOS, and this was just happened to be AMC had earnings and everybody in the chat was talking about it. By the way, shameless plug, we do have a Discord group. Link is in the chat. Link is in the description. Feel free to check it out if you like. It's free to join. We do have a premium service, but we do have weekly free sessions open to everybody. It's free. So feel free to pop in, and we do have a lot of lessons going on, at least weekly. There's one lesson at least on something going on. So feel free to pop in. The link is in the description. But anyway, let's look at AMC here. Underneath this neckline, let's take the measurement, 18.73%, 18.72%, couldn't get it exact there. On the extension upside, I just wanted to bring this chart because it was a perfect representation of just a non-perfect inverse head and shoulders, right? We had our left shoulder, our head right here, and then our right shoulder. Notice how this neckline is ascending. It's ascending up. So the buyers are strong in the final phases of this inverse head and shoulders, signaling that, okay, the break above might be a really nice break to trade. Breakout to trade. We pull up our volume chart, we put an RSI on there, maybe a MACD, whatever, like we were saying, and the MACD is crossing, the RSI looks strong, and you're getting a large volume influx as the breakout is happening. That's really, really good. That's a good thing to see. So take that breakout of the neckline. Now I wanted to show you this because look at this perfect retest of the neckline here, right? We had, let's just say this was Friday. I believe it was actually Tuesday, but let's just say this was Friday. This was Thursday here. Thursday was the breakout. You could have traded this. Perfect retest of the neckline. So that's why you always want to be keeping in mind that, okay, you're going to have that retest of the neckline to confirm that it's actually support or resistance. You're going to have that rejection or that bounce, and then you can take that trade thereafter after that. And if you're not that type of trader to take on that much risk, you could always wait for it to break that recent high that it's made after the breakout that it made to pull back to that resistance or support and then trade above there for the full extension of the inverse head and shoulder. So one last example here is AMD. And really I wanted to provide this example because this is a really convoluted chart. And we trade AMD all the time. Personally, it's one of my favorite stocks to trade all the time. And I personally love it. However, this is really convoluted. You've got a lot of selling pressure here. Then you had a massive bounce, little M pattern that we definitely traded. We actually took advantage of this on this day. That was really nice. That was crazy. That 13% slide was nuts. And then you have this weird formation of the head and shoulders, but it's just not clear. You had all this selling pressure and then a head and shoulders form. It's just not clear. There's a lot of price action going on. This is a head and shoulders that I personally wouldn't have traded. I might have traded inside of this price action in here because I trade AMD almost daily, but I wasn't looking for the head and shoulders in here. In fact, I definitely didn't identify that this was a head and shoulders because it just isn't clear. And it lowers the probability of the head and shoulders actually playing out the way that it should. So it's really nice to have a clear identified inverse head and shoulders, et cetera, like this. You have nice, easy M pattern, comes down to back down to support. After it made a left shoulder here, the head is forming. Okay, we find our right shoulder. Now you take the break out of the neckline. That neckline was also a huge support on this M pattern here. It's also a big support over here, very identifiable. Oh crap. But if you go to this AMD, it's just too convoluted in here. I mean, just look again. This is really simple. Downtrend, left shoulder's made, a little bit of consolidation, drops back down again to make a head, pushes back up to make the right shoulder, and then you have your neckline, break above the neckline. Very simple to identify, not so simple to identify. So this has a lot less high probability. So I'd just be keeping that in the back of your head. Don't just try to trade a pattern because you've seen a pattern in a chart. Make sure that it makes sense. Make sure that it's easily identifiable. You can see that actually the result here was 6.5% was the extension. The extension was only about half. So you might have actually you might have either captured that trade, but then poorly executed because you had your supports and resistances all out of whack. Either way, just try and stay away from those more convoluted patterns in general across all of the different types of patterns, but also head and shoulders, because that's obviously what we're talking about today. So anyway, some major key takeaways, head and shoulder patterns are the reversal patterns. So they are reversing the price action from a bull trend to a bear trend, or a bear trend to a bull trend. More often than not, head and shoulders aren't perfect, right? So you'll get that ascending or descending neckline. Play accordingly. Make sure that the reversal that you are predicting is going to happen is in favor of the secondary party, like the sellers in a regular head and shoulders, or the buyers in an inverse head and shoulders. Volume should decrease on that third peak, that right shoulder, and increase on that breakout. Really, really important for that volume is increasing on that breakout. And then lastly, a breakout occurs when that price breaks above that neckline. It's going to retest, reject, or bounce off that support or resistance, and then rerun above. And you can trade both that breakout, the retest, or both of them combined, but just make sure you're utilizing your risk management properties. With that being said, that was head and shoulders. Hopefully that was really nice and simple. Hopefully I didn't talk too fast. Make sure you guys leave a couple comments down below if you want us to go over a pattern, an indicator. We've got some indicator videos coming out for you guys soon, actually. But if you guys want to hear anything from us, we'll go over what you guys want to do. We're also a very new channel. We're trying to grow here, so we really appreciate anybody that gives us a thumbs up or subscribes. And we've got all types of links down in our bio to check out. Discord group, we actually just dropped a merch line, limited supplies, so definitely check those out if you want to support the family. And then, of course, we've got some other free goodies for you guys in our website as well, like a starter kit bundle. And if you really wanted to, reach out to us for a free code on our risk management book. Anyway, it's been Zach from iTrendz. Peace out. Have a good weekend. I'll be on vacation next week, so I know I'm about to have a good weekend. Anyway,